Good afternoon, everybody. Welcome to your Wednesday edition of the TraderMerlin Show. Do me a quick favor and just, as we progress with today's show, be very critical about video errors, audio errors. I spent, a couple hours last night. I tested out 2 brand new cameras, one that I bought with the donations from you guys, so thank you very much. I could not get that one to work. And then I have another really incredible 4K camera that I was trying to use. Couldn't get that one to work, so I'm back to my old camera. I think the colors are okay, but I noticed that my audio, my microphone wasn't working. So if I have issues, you guys let me know as we progress today. Don't feel shy for letting me know. I'm definitely going to try to fix everything, but it takes time, and I'm not that much of a tech geek, so I'm doing my best. Anyway, happy Wednesday, everybody. It's the 10th of August today. An abrupt not about face, I guess just a spike up for our equity markets out there today. Unfortunately, stopped me out of my short positions, but the good news is that Tesla trade that I went in erased all the losses I incurred today and still left me with a profit for today. So I was pretty happy about that one. Still looking a little sunburned? Okay, I can dial the red down. I thought I got most of the colors back, but maybe it's because I'm really hot and flushed. Actually, one other quick piece of news. Friday, I gotta do no show. And the reason is I'm getting AC installed upstairs. I can't take it anymore. I'm sweating like crazy here, so maybe I'll look more regular. But Friday, I can't do a show because he's gonna be here installing as I would be doing the show. So apologize for that one, everybody. Okay, yeah, Brandon, bula bula. Hope your long positions are killing it, brother. All right, today I'm going to talk about this one, the death of inflation. Obviously, some of the economic announcements that happened today have everybody really getting all optimistic, thinking that, hey, this could be the end, and all of a sudden, inflation's now over. So I'm just going to throw this out there. I know that most aren't online with our group yet, but I did a little poll here. Was that the peak inflation for this cycle? Meaning, are we done? It was 9.1 as high as we're going to get, and all of a sudden it craters from here, and we get back to that 2% inflation that the Fed is looking for. Just curious what people think. It's just a matter of opinion. Nobody knows the future for sure. There's a lot of other things we can look at, and we'll talk about a bunch of that today. But I was just curious what you guys think, so I'm going to leave that up there for a little bit. Yeah. Well, I definitely, what are you going to do? I got to take Friday off. Maybe I thought about doing the show early, but you know what? I'm due for a day off, and it's the last day of the OC fair, so maybe I'll even go to the fair early that day. All right. It looks so far like 70% of you say no. Let's look at the data. Then I'll look at some charts, and then we'll just do all kinds of talking for today. So here is the death of inflation. Now, real quick, let's look at earnings. Nothing overly wild here. Of course, we can look at the Disney chart, which reported earnings after market close. They're up another almost 6% right now after hours, posting pretty good numbers, although you're hearing a lot of stress on the streaming services as they're losing a lot of subscribers. Apparently, Disney did something that made everybody very happy there. But none of this stuff really matters to me. Let's go to the good stuff. Here is what it matters. Now, you notice up at the top, all the data was pretty much in line with expectations. We did see the yield drop on the German 10-year pretty significantly from 1.4% to 1.1%, but it's really the CPI number that you see here. Now, we've been talking about this quite a bit over the past couple of months on how commodity prices were bound to have an impact on this going forward. I thought it might actually be next month or maybe even October, but we're starting to see obviously an impact from those commodity markets and just maybe the actions of the Fed, which is questionable, on CPI. Previous number was 1.3%, which gave us that 9.1 year over year. They expected a 0.2% increase in CPI, meaning it's still growing, just not as fast as it was. And here, all of a sudden, inflation for the month of, let's see, we're out of the target. For the month of July, pretty much stopped, which is shocking. And here's the numbers, just so you guys can put it into perspective. The last time we had zero was back in late 2020, right? We obviously had some contractions for the COVID thing, but pretty much just rising prices ever since then with a couple pullbacks. So I think a lot of people are looking at this saying, hey, it's over. Now, personally, let me just end the survey here. 77% of you said no to inflation being over. I put myself in the no camp. Main reason for that is I just think that there's too many market headwinds. There's so many things coming down the pipeline that just add an air of unpredictability to the market. Now, my main reasons why I do feel that inflation is going to have a pullback, as you guys, the regular followers, know, it has so much, in my opinion, to do with things like this. Here's lumber, down 71% since March. You've got natural gas, which is back up to where it was, but it's down a little bit. You've got wheat. This was like a 40% decline. Cotton, another massive decline. You've got corn, soybeans. This obviously at some point will come through. And this is what I was asking Don Dawson on our last week, was saying, hey, what do you think of this? How is this going to impact? And I thought it was interesting because he was saying that the users of these commodities, Colgate and not Colgate, Kellogg's cereal and stuff, they're locking in their futures contracts. So they might be stuck for a few months before they can start to, rebuy those futures products and lock in new prices. So maybe there was a tapering off period where we had to kind of wait for things to fall off their books, and now they're resetting their prices, and maybe we start to see some of that decline here. So it's good in the short term. Now, are we going to get to 2%? At some point over the course of history we will, but are we going to get there, by the end of the year, as I heard someone say today? I don't believe there's a chance in hell we get to 2% by the end of the year, maybe sometime, 2023, 2024, but we still have a lot of factors pushing up on inflation. What are those? Well, we could take a peek at the U.S. dollar, which of course is a major driver of inflation, and this is a kind of a tricky one, but we saw a pretty substantial decline today in the dollar, which I think is part of the reason why you saw these markets go gangbusters. I mean, S&P was up 2%, NASDAQ up 2.7%, Russell 2.8%. Good lordy, it's party time for the bulls out there, right, Brendan? Party! So if we continue getting weakness in this dollar, which I'm torn as to saying we are going to see weakness in the dollar. I personally think it's going to continue on this big uptrend here, but I got to ask, from a macro perspective, how do we? I'm not that hot, but I am starting to sweat. How do we anticipate dollar moves? It has to do with, do people want to buy U.S. goods and services from international, right? That would be the tip. IBD economic optimism numbers is one factor where money is coming in to the U.S., and if more money pours into the U.S. to buy our goods and services, that means they're going to need to convert their currencies to dollars, which would drive the dollar up. So as long as seems to be economic opportunity, foreigners will be buying U.S. dollars. The other part of it, which I think drives that U.S. dollar up, was the unwinding of the balance sheet. Now, because this new twist in CPI going down to zero and basically showing a significant contraction in the inflation numbers, because that happened, now we have to start thinking, how does the Fed react to this? If the Fed reacts to it in a very calm manner and basically says, look, inflation's dropping, our rate increases have helped, we're going to increase maybe one, maybe two more, but as I showed that chart yesterday, inflation has to come down because it was super high, and the Fed funds rate has to move up. At some point, the Fed funds rate is going to cross above the inflation rate. My guess is that's going to be somewhere around 4%, which, I think that could happen by the end of the year, 4.5%. Fed funds rate. That would mean some aggressive rate increases going forward here because we're not out of the woods yet. Now remember, the Fed also has been using the unwinding of the balance sheet. In order to fight inflation, you remove money supply. All those bonds they bought, now they're starting to liquidate. Many of those that aren't going to make it to maturity, they take that cash, they retire it. Fewer dollars means stronger U.S. dollar. So it's tough for me to sit back and kind of say, okay, well, what's this all mean on the macro level, and how is these inflation numbers today going to kickstart it? I don't think inflation is dead. I think for right now, I would contend that we probably have peaked with inflation. Just for right now, I want to wait and see what happens a little bit later on in the year. I think there's still some fallout to happen from that past sell-off. I think you got political issues going on. I think you got macroeconomic issues and tensions with China. And if that escalates at all, then I think the inflation numbers could really spike up. One of the interesting talk tracks that's been going on right now is talking about chip makers and semiconductors. And obviously, Taiwan is the fulcrum of the global chip-making community. Yeah, we make some chips here in the U.S., but if Taiwan gets taken over by China, and China now takes over the production of semiconductors, we are dead in the water, and we're probably going to see some significant inflation, big time. Lisa, I would definitely say the trend right now is going to be, at least in the intermediate term, bullish. All right, today's action proved that on the S&P 500, which stopped me out, unfortunately, but jumped above my levels. Okay, I'm out. It sucks. I hate to lose like that. Let's run through these market indexes real quick just to paint a picture. I'll start, and let's do our top 7 like I normally do. Here is gold. right? Gold showed an interesting one today. We've kind of been stuck at this level for a few days, just can't seem to really get some strength. It actually rallied up fairly decently today, getting to a high of almost 1825 before just selling back off. And, having a dollar as weak as it is today, I really thought you would see gold spike more. Now, what's interesting is gold didn't. You can see SLV has a very similar picture. Right, percentage-wise, it did better than gold, but gold was down 0.24% on the session. Not great considering how weak that dollar was. Now, commodities that did do well with that weak dollar. No surprise, you saw crude oil rally 1.18%. I certainly don't think that this trend is over, this downtrend, but the stronger that crude oil gets, the weaker that dollar gets, I think the more opportunity there is for upside potential here in crude oil. But right now, still in a downtrend. Now we get to the indexes. Inflation is caused by only one thing, expansion of the money supply. Well, I don't think it's one thing. I think that there's many pieces of it. So let me, now you threw me off there, Randall, but it's a good point. If we increase the money supply, you have more dollars chasing the same amount of goods and services. Okay, great. But what happens if we have supply constraints? What happens if we have lumber mills shut down because of COVID? What happens if we have a bad crop of wheat? What happens if we put tariffs on China or Mexico for their goods and services? That's not really increasing the money supply, is it? Those are other actions which could significantly impact demand. And all of a sudden we have supply contraction, let's say lumber, because the lumber mills have shut down and demand for housing remains really high like it was. What happens to the price of lumber? It goes through the roof, which now becomes inflationary. Same thing with wheat or corn. For example, we talked about... with Don Dawson, we talked about this kind of bumper crop. This bumper crop in Brazil where they get 2 crops per year and they're going to have a bumper crop, which means they're going to be flooded with corn, according to the report that's coming out this Friday, which hopefully we'll see. What does that mean? That means that any U.S. producers who aren't getting a bumper crop or who only have 1 crop per year, they're going to be left with a whole bunch of corn that costs them a lot of money to make, and the price of corn is going to drop. So, there are these different impacts that influence inflationary numbers, but certainly the number one piece would be inflation of money supply. And that's been my, my stickler point for a long time, which is how much the money supply has increased just the past 2 years is 10 times what it was the previous 70 years. That is just mind-boggling. Brendan, Merlin, those exogenous, I think you can't use 3-syllable words or more, bud. Just keep them to 2. Exogenous variables cause rising prices in goods. That's not the same as devaluation of a currency, which is the direct manifestation of inflation. Correct. You're right. It is. It's the devaluation of that currency. Absolutely. Well, and again, I think right now is an attempt by the Fed and central banks to fix that by removing money supply, but we'll see how that really works. Ultimately, the last thing we'll see is a raising of the reserve requirement for banks, right? The Fed can tell the banks what the reserve requirement is. If they do decide to raise that reserve requirement, that'll be kind of the last, in my opinion, last ditch effort for the Fed to rein in capital, but they want to make sure that lending is still there, so they're keeping those banks kind of propped up at this point. All right, let me get up to the top 10 here. We made it all the way up to crude, and then we got to the indexes. Here is a great shot of the Dow ripping into that zone and getting right near the higher end of it. Now, almost every other index that we have looked at has hit this zone and gone through it. Right, so if you're looking at this thing, hey, it might be a shorting opportunity for the Dow, careful, right? This doesn't necessarily mean that it's going to sell off from here. In my opinion, it looks like it's going to just rip right through it, especially with what's happening tomorrow, which we'll talk about in a second. There's your S&P, right? It broke above that level, so 420 was my number to get out. Actually, it was 420 and 5 cents. We got stopped out today. It just barely broke above 420 on that S&P, but broke above that area where I was anticipating some sell-off. Didn't happen. No worries. It's fine. I'll move on. I'll live. Here's your NASDAQ, which actually is coming right up into this other red line at 13,501, right? Call it 13,500 for the NASDAQ 100 futures. The important part, we're still respecting this trend line, at least up until right now. But yeah, out of that one as well, I kind of want to stay short the NASDAQ just because of the level we're coming into, but I'm not going to fight this one. I think standing in front of this economic data, we have the CPI number come out today. You're going to have producer price index come out tomorrow. If that makes the Wall Street guys feel warm and fuzzy about inflation numbers, you should get another rip up tomorrow if it's a really good PPI number that comes out tomorrow. Again, that's going to be at 5:30 in the morning, 1 hour before the markets open tomorrow. So it will be a wild one for sure. But boy, today really reacted positively on these indexes. Notice that giant green candle that erased 3 days of losses on the NASDAQ, S&P, and the Dow. Now here's the Russell. This is one that I wanted to short 2 days ago because it was coming to that supply level. I did not. Maybe I just gut feeling or whatever, but I decided not to because I didn't want to have too much risk exposure. Going counter trend. As you guys heard me on Monday, I really wanted to short this one, but I was going counter trend here, which of course is a very risky thing to do, going against the grain, and it just kind of felt like there was some positive sentiment going on in the market, so I didn't pull the trigger short on the Russell, which is a good thing because as you saw, the Russell ripped up through that level would have stopped me out either way. Now, I guess now we got to look for is what are those next levels for the Russell. So I'll just put a line right here just to get things started. That should snap there. Right around 2025 is that next target for the Russell. Today we're at 54 points, roughly 2.8%. Well, that next level at 2025 is about 60 points away from current levels. So another, 3% we'll be hitting that level here very, very soon. Short equals fighting the Fed. Yeah, well, in my mind, shorting was going with the economy, right? Going with the trend of the market. That's why I was short. So I certainly know better than to fight the Fed. Lastly, since we are in a situation that is ultimately risk on, right? For those who might have never heard these terms, risk on or risk off. Risk off is obviously where you pull away from equities, you move towards safer investments, maybe go into bond markets because that is theoretically safer. Here we're seeing the opposite. We are seeing a risk on event where everyone was just piling into equities today. And of course, a big risk on security, cryptocurrencies. So Bitcoin today up another 3.7%. I'm liking this. I bought another $5,000 worth of Bitcoin today. Now, it's kind of tricky at this point because you notice this chart here is an ascending triangle. Now, no pattern guarantees anything, but what it does tell us is that it's building strength. It's making higher lows. It's got roughly the same highs, right around 24,310, and we hit it today, sold off a little bit. So the longer that this does this, the more likely it's going to rip to the upside. And the main reasons for that is it keeps taking away whoever is unloading and selling at this 24,310 mark, which you can see has happened 1, 2, 3, 4, 5 times. Ultimately, it eats away at that supply and price will rip through as long as demand stays strong. And given some of the things that's going on in the crypto world, it does seem rather optimistic. Going off the 4-year cycle pattern, which I put a lot of weight in because it's happened 3 years in a row, it kind of told me to be bearish on crypto till roughly October, maybe November before we started to see it turn. Well, maybe we're 2 months early and we're seeing the bottom put in. I still got this gut feeling we're going to see some downside, but right now price chart's telling me to go long, and I added more to my current position, and we'll see. I'm going to keep building. There's a couple more I want to add to, a couple more securities I would like to add to. Ooh, I can't even say that because the SEC has not said their securities. A couple other cryptos that I do want to add to my portfolio, and I may start adding some more of those positions soon. All right. Now we're talking about how many push-ups the president can do. He was having a hard time putting on his jacket the other day. It is what it is. We can always vote if we don't like it and make our changes heard then. We closed above 200 pay moving average on SPY. It didn't happen in the 2008 bear rally. Yeah, and again, those are important triggers. So let me add in the moving averages that Brendan is talking about, which in this case would be the 200 period moving average. So here's your 200 period moving average. We'll go back to the S&P 500. And, you look at where we're at. We're still trending down. So you said here the 200-day moving average on SPY. No, we didn't even come close to it. We're not even remotely close to our 200-period moving average. I mean, you got to get up probably another 5% to get to that 200-period moving. But to go to your point, in that 2008 bear market sell-off where things are really aggressive to the south side, let's go look at that real quick. All right, here's where you had it. You actually did break above it in 2008, but it took all the way until 2009 before we got above that 200 period moving average. And this is one reason I don't like these types of indicators. A lot of people like it. Oh, you're using EMA. Generally people don't use EMAs for long-term charts. EMAs are normally used on shorter time frame active trading. And the reason for it is it puts more weight on the most recent data. So it kind of skews the whole thing. So yeah, maybe that's the case, but I don't use EMAs on long-term charts, just short-term ones. Anyway, I thought that this was noteworthy because there are a lot of people that will use moving averages and say, well, I'm not going to buy until it crosses above the moving average. Well, at that point, the market had already moved up 37% off its lows. That's a lot of money left on the table. Lots of money left on the table. So, I think moving averages are a poor way to time the markets. They're a great decision support tool once you're in to stay in something. I don't know if we're in that. Here's my continuous contract of the S&P. So I don't see it hitting it. You're talking about the current contract? Oh no. Yes, that was wax on, wax off, Michael. Wax on, wax off. All right. Well, I'm not going to go back and forth. On the S&P. For me, they're both well below. And I think you look at most of these right now. Here is Bitcoin, which is well below its 200-period moving average. Russell as well, plus the moving average is pointing down. Same thing with the NASDAQ. We're still below the 200-period moving average, and it's trending down. S&P, same situation. Dow, same situation. Crude oil is the only one that's just recently broke below its 200-period moving average, and that 200-period moving average is going up, which is unique compared to most of these assets. And gold, it's just flat sideways. Doesn't really make much of a difference here with gold because it's been so choppy and overall sideways for quite some time. All right, the 200-day EMA provides a good back test with 5. Okay, well, as long as the data works for you, great. I just personally don't use them because I feel it skews the data in an incorrect way. When I was a short-term day trader using 5 and 15-minute time frames, I would use EMAs as well as EMA crossovers simply because it may alert you to those changes quicker. That's the main reason I would do that. You guys are funny today. All right, so there's my view on it. If we look at the death of inflation, inflation is not done, guys. It's just having a pullback, just like anything. The trend has been up aggressively for a while. Normally, there's going to be a pullback. I'm curious to see how low the numbers go. As I mentioned, you've got really low Fed funds rate and high inflation numbers. There's only a few things that are going to happen. Either the inflation is going to keep rallying, and the Fed's going to have to play catch-up, or inflation is going to drop down, but the Fed still needs to play catch-up. The Fed needs to get their Fed funds rate above the inflation rate just to be safe. What was the other piece I want to look at? Oh, you guys might remember that the industry was pricing in 75 basis points for the FOMC meeting for the next one, and I'm like, no. You'd be lucky if we get 50. 50 was my target, and notice all of a sudden in the last 24 hours, huge drop. Right now, the expectation is most likely a 50 basis point increase for the Fed funds rate at that next meeting. And I'll tell you, if the PPI numbers come out exceptionally good tomorrow, meaning 0, you might actually see this drop even more. You might see them think maybe 25 basis points. But I do think we're going to get 50. I would make a wager for anybody out there. Let me get Bill Addis in the program because he already owes me 2 beers because he's been wrong on the FOMC rates. So I better get him on before September 21st so I can make a wager with Mr. Bill Addis there. Can we see the Federal Reserve balance sheet trends 1 year or more? Let's see if I can find the current piece. Recent balance sheet trends, Federal Reserve. Now, what it should be doing, hopefully this is graphical. A lot of times this is database, which just sucks. This is where I want TJ. TJ's always good at like bringing up charts for me and doing research while I have to. Come on. Well, something's glitching here because it's not letting me get to the FOMC. Balance sheet, that's too old. There we go. Balance sheet trends. So there you go. And it's exactly what it was anticipated and what they've been saying. There's the balance sheet, which is just insane. Especially when you look back and, you know, this chart looks like something that might have been like 100 years old. It just goes back to 2008. Only 2008, the Fed had only 8.6 They're 869 billion on their balance sheet in October of 2007, and we just peaked out up here, 8.9 trillion. That's insane. That's 10x. Unbelievable to see it that much. But what we are seeing is that rollover. And again, I think that this is part of the reason we're getting some strength in that U.S. dollar, is that this is starting to dip down here. But that's the current Fed balance sheet. Again, they are trying to unwind. I believe right now it's the tune of $90 billion a month of mortgage-backed securities and treasuries, as well as, I believe, some corporate debt. So there you go, Brendan. Can all the new retail traders be making a difference as to how the markets are acting? Honestly, no. I really don't think so. I think that the retail guys, I apologize, this sounds bad, but it's the way I view it myself personally. We're nothing but mosquitoes on the backs of elephants. So we're pretty insignificant, There are some, I guess you can have some heavy retail traders using lots of leverage and might be able to move the markets, but for the most part, we're mosquitoes on the backs of elephants, which is not a bad thing as long as you know your strengths and you know your weaknesses. I think I told you guys the reason why I called myself Zenzade for a while, and Zenzade means mosquito, just from a trading perspective. And the reason I say that is I was writing a paper when I was over living in Italy, writing some stuff for the class I was teaching, and I went like this, and this mosquito flew off my neck, and he was so fat with my neck blood that he couldn't fly, and he was bouncing on the desk, and I just went boom and smashed him, and nice little blood stain on the desk. But to me, that is exactly how we should view our trading. We have to be that mosquito, and if you get greedy, in this case, that mosquito got greedy. He didn't need all that blood, but he got comfortable. I have maybe some good taste in blood or something. He just snacked too long. He could have gotten away. I would never have known, and he'd be living a happy life. Instead, he got too greedy. You expose yourself too much, and then you can't get away like you normally would. To me, that's the advantage we have as smaller traders, is I can get in there and get out, and get a little bit, and move on without making a big wave in the market. I never have any aspirations of being a market maker or an institutional trader. I'd rather be the guy, gets in there, gets exactly what I need, disappears. Boom, gets a little bit more over here, disappears. Get a little bit more, disappears. So, Zenzade, the mosquito trader. I'm the market tick. I will gorge on BlackRock fund flows. Ugh. I don't know what I think's worse, mosquitoes or ticks. I will go with the mosquito because at least I can fly. You can't do anything. You can just sit there and crawl around the other side of bushes and hope someone rubs up against the bush. Bellata said the other day the Fed is going to remove $90 billion from the market for September. Won't that push inflation up? Well, what it's doing, it's removing dollars. So it could have a couple different impacts here, obviously. The main thing is if you're removing money supply and demand for dollars stays exactly the same, right? It's all supply and demand, whatever we talk about in life. But if you keep demand exactly the same for U.S. dollars, so that includes all foreigners buying U.S. goods and services, converting their currencies into dollars for goods and services, etc. If that demand stays the same and we're taking more money away, meaning our supply of dollars is decreasing, what does that do to the value of the dollar? It's going to drive it up. If demand for dollars stays the same but supply declines at all, price of that dollar is going to go up. And now we're removing $90 billion a month from money supply. So if demand around the world increases for whatever reason, maybe they want to buy more commodities, or maybe they're trying to buy oil. Great. They're going to have to do what to buy oil? Dollars, because it's priced in dollars. So is gold and most of the commodities. That's the power of having the reserve currency of the world, is we can do that for now. In the future, who knows how that's going to be. But that that is, to me, is I guess the impacts that dollar is going to have. The removal of money supply should continue to push the dollar up, which is why I've been, expressing my bullishness on the dollar. But everything can change, and I would actually argue that we're getting close to that point where it's potentially going to turn. So, we got these levels here. I'll move this line down here. This right here would be where it actually would make a new swing low. And if it gets below 103.50, well, then this uptrend, in my opinion, is broken, done. Now, we've got a ways to get there, and we fell a full point today, which is about 1%. We could easily get there in a couple of days with a nice bearish move, and given what happened today and maybe PPI numbers tomorrow, we could see the dollar index fall even more. Now, if the dollar index gets down to this 103.50 mark, the equity markets are going to have a big surge, right? Yep, Dipsy pop from all the fear. Yep. And I think that there's still some fear out there, but I think a lot of it now has to do with the Fed unwinding their balance sheet, as I mentioned. So if we do get that Dixie to drop all the way to 103.50, well, your S&P is probably going to shoot straight up to this 4,300 mark, which would be the next most logical area of supply. So you notice how there is a correlation to some extent on how these instruments will find supply and demand zones, even though they're inverse, right? So if this dollar, if that dollar index breaks down and hits this 103.50 mark, I would expect this S&P 500 to be back up here right around 4,300. And at that point, I will take another stab at shorting, but that will probably be the last one. And the main reason is, at this point here, we've broken the implied downtrend from this series of lower highs and lower lows, right? Today is a break of that, and that has to change my mindset. Monthly candles are pure in the USD. You can look at the monthly candles if you like. Boom. There you go. So the only thing I don't like about looking at monthlies is a lot of times it doesn't allow me to see these levels. So now if I was to look at this from a monthly, from a trend perspective, it would have to get down below 101. I'd have to make a new pivot low, and that's obviously a much lower calculation. So I generally don't. I like to look at them, but I don't make my trades off of it. You can see here when I look at the weekly, I get a better understanding that this is a new point where it made a swing low and then ripped up. So that becomes my new target there. All right, let me get to some questions here because I don't want to run out of time, and I usually do because I tend to ramble. One thing I really hope was evident from yesterday's show, and I don't advocate or push any style on anybody. I think everyone needs to find their own style, and I felt really bad for the individual who sent me that email saying I'm down 80%. I was like, you know what? There's a lot of people in that same spot, and I think what happens is one of two reasons cause that, in my opinion. One of three reasons. Number one, you're just gambling, you have no plan in place, and you're shooting from the hip and hoping to make money. That's not the right way to do it. Number two, you have no strategy, meaning there's no approach to you. You're just winging it. Number three, no stop losses whatsoever. And I think for all of us, in looking what Jerry was talking about yesterday, some of you may not have liked that. Some of you going, that's not my style, doesn't work for me. Great. Doesn't bother me at all whether you like or dislike someone's style. Bottom line is it has to fit you. And I think Brendan's a good example of that. Brendan, if I remember correctly, you were trying to do short-term stuff and it just wasn't working for you. And then all of a sudden you stepped back and said, hey, let me do more swing and position stuff here. And all of a sudden it's working great for you. That's a discovery process, right? You have to find that out. And I'm sure early on, Brendan, you probably had somebody persuade you or show you that they were doing so great at day trading. You're like, man, this sounds awesome, right? In and out at the end of the day and generate daily income. Awesome. So we have to find out what works for us. And I wanted to share this one because Skilled Stocksman, who's one of our regulars here, sent this in. He says, I don't know how to explain it, but I'm 70% Bob Dunn plus 30% Jerry Baldwin style. My best guess at that, but it's what's working for me. And that's what I like about this, is you said, that's what's working for me. I would say I don't know. If I'm not 50-50, I would actually be maybe 60-40 longer term. And I guess when we say it here like this is not to say that Bob Dunn is like, the greatest trader in the world, folks. He's just a longer term, big picture trader. So we should just associate those two together. Whereas Jerry's saying I'm shorter term, intraday, maybe a swing for a couple of day type trader. I personally prefer having swing trades that last me a few days to maybe a couple of weeks. I don't really like being in things for months or years unless it's cryptocurrency, in which case I'm in it for 5-10 years and I could care less what happens to my Bitcoin portfolio. It is what it is. I know it'll be fine in the long term. But as a trader, I have to be a little more active than that. So, it tells me, Skilled Stocksman, that you're much more of a longer term guy. You're looking at the longer term swings, days to weeks, most likely weeks, maybe even months. But big picture, trend. Let's see here. I'm going to read what Brendan just said for those who are in the podcast. And by the way, shout out to those that do listen to the podcast. I know we're on Spotify, I'm on iTunes, and a whole bunch of different stations. But if you get a chance to join us live, it's much more fun because you can interact and see the charts. Where a podcast, you have to do theater of the mind and dream the whole time. Brendan says, Merlin, it's also probabilities. Long-term holding periods have really good profit probability history. Historically, holding an equity for one day is 52% historically profitability. It's a coin flip. Yes, and I think you have to look at that from another big perspective also, is understanding the context of the trend, right? while I agree with you that the longer term holding, just because of the way markets are constructed, you're going to have greater winners, most likely, over time by holding. However, you could go through, mind you, we've been in a period since 2009 to 2020, call it 2022, where the markets have done nothing but go up. Nothing but go up. A couple of little pullbacks here and there, big deal. A little COVID drop, blip on the radar. At some point, we will get a nice trending market down, which might last a year or 2 or 3, right? You had it in the roaring 20s where it was like I think a 7-year down market. That can happen. At that point, buying long and holding is not the way to go, right? It's about identifying that trend has been trending down, which is, why I keep emphasizing my trades that, look, I'm going with the trend and I'm explaining the time frame of that trend. Most of mine are going to be on the intermediate to shorter term time frame. The longer term time frame is still up for the overall equity markets on the grand scheme of things. Chatting is fun. Oh, Lisa, this whole show, it just gets stripped down of all the audio or all the video, and I just upload the audio track to iTunes and to Spotify, and I think there's some other podcast networks out there. So there you go. But I think y'all agree. It's better when I can flip over here and say, hey, let's check out this chart of the U.S. dollar and draw some lines on it and make it look all pretty. So good, Skilled Stocksman. I'm glad you know that, and I know that yours has been a discovery process as well. All right, so Twitter and Elon Musk, the ongoing soap opera. Michael says, I heard Elon sold $6.9 billion, not shares, but $1 billion worth of Tesla stock. Do you think it's really because of Twitter, or does he see a worsening economy ahead? Do you think he will be forced to buy Twitter, or can he just cancel the deal and say, I don't know if he can cancel it. And I'll read the second part here just because I think it's important for everyone. Hopefully you all went and watched that video, but and you can see Red Merlin, yeah. What's that? God, there's a great movie, Hellboy. I look like Hellboy today, or the other day. Last part of Michael's question, it says, I also watched the Kramer clip. Man, that guy is a crook, bragging over market manipulation, speechless. Yeah, and I think this is what was so important for me to watch that video. Whether you love him or you hate him, you have to understand, part of me tips my hat to him to say, you got some chutzpah to say that stuff, because that is what really happens. Now, he's like, well, I wouldn't do those types of things. But in the same sentence, he says, I would do this and I would do that. It's like, okay, you're kind of contradicting yourself here, Jim Cramer. But for those who haven't seen it, again, go on YouTube, type in Jim Cramer manipulation, and just watch that video. If you are a fan of the markets in any way, shape, or form, kick back, watch, I think it's 7 minutes or something. Your jaw will drop and you just go, what a crooked industry. And, Jim Cramer is no patron saint. That's why most of his picks are wrong. So regarding Elon Musk, look, we can go check out Twitter. I personally think he's going to beat and win this case against Twitter. If Twitter can prove that they have less than 5% bots, then they've got a good argument. But he's asked repeatedly, and they will not produce that information. They will not show, and they've done studies on it. They have to. There's so many bots on Twitter, it's ridiculous. If I write in anything, if I just type in the word crypto on a Twitter post, I get dozens of responses from bots. Oh, check out this and buy this, and hey, I've got an NFT project. It's all bot. You can tell because they're all repeated boilerplate. Will he be required to buy Twitter? He could potentially, right? There is definitely that possibility that he is forced to buy Twitter. And I don't think that he's selling the shares of Tesla right now just for that. I think he realizes that he's got all his eggs in two baskets. He's got all his eggs in two baskets. It's, what did he say? The only two equities that Elon Musk owns, the only two stocks that he owns, is Twitter and Tesla. And of course, the vast majority of it is Tesla stock. So he is he's heavily weighted in one security. And I think even he, as bright and intelligent as he is, understands that maybe he should be taking some of that off the table, diversifying a little bit. Now, I know that the purists would say, well, if you think your company's so great and it's going to be even bigger, then just stay with it. Yeah, it's also about diversification of your holdings, right? Keep in mind, he's got the Boring Company, he's got SpaceX, and I'm sure he'll now venture out and do a few other things. It would not surprise me at all to see him start up a cryptocurrency project, maybe some kind of blockchain infrastructure piece with a group of developers where he's the head guy. Why not? I think that some of it might be as a contingency just in case he's forced to buy Twitter, because you're hearing about some of his investors backpedaling and not feeling so comfortable about loaning him billions of dollars. So maybe that's part of it, but tell you what, if I had that much money sitting in one company, I would sell out some as well. With regards to Twitter's price, or not Twitter's price, Tesla's didn't really have too much of an impact. We can add on volume here. And, where did he sell that? Who knows exactly when. My guess is it's a quarterly report where he filed a specific document saying, hey, I'm going to sell X amount of shares, and he has a certain window of time to do so. But, you can make the argument that it happened here on August 5th and 6th, but really it didn't look like it has that big of an impact on it. Now, of course, my feeling was we came into this kind of a rally-based rally back on the 28th of July, so that was the buy point for me yesterday as we pulled back in where I bought my call options. And just one, unfortunately. I really should have bought more, but it is what it is. Yes, and that's exactly my point, Dave. We talked about this on yesterday's show. I bought Tesla specifically because they made the announcement on the stock split on August 4th, and it's had 3 ugly, ugly days right into a demand zone. So I bought a call option. I am currently long 850 October call option on Tesla, which of course today just had a huge run up. It was nice. It offset all my losses that I took on NASDAQ and S&P puts. So, running up into the exercise, meaning that's this blue vertical line where we'll actually get declared, I will probably sell out my option between tomorrow and some other date that it rallies up, but probably a couple days before that execution. My guess is we should easily be up right around 9:30 by then, just because people like to buy this stuff and pop it and get the extra shares in their account. So he has $11 billion now, liquid assets, cash. Wouldn't that be nice? How much you got in your cash account? I'm looking through, we look through our bank statements like, ooh, yeah, I got $20, $30, $40,000. I got $11 billion. I need to, do you have a wide screen so I get all those zeros in there? Let's see, Tom. Elon is selling because Tesla's EV market share is on track to drop 11% within 2 years. Mind you, he knows. Right, so when an insider is selling, it always makes me raise my eyebrows, and plus they've been splitting multiple times. So I think that, as Tom definitely agrees or feels, is that the steam is kind of running out of Tesla, at least for the growth phase, that exciting period of time where everything is just boom, boom, boom. I think it's going to start to slow down here, and valuations make it back down to realistic levels. But either way, I think he's doing the right thing. If I was him, I would be taking money off the table. If you want to be disgusted, let me see if I can find this for you. If you go to Yahoo, actually maybe not even Yahoo. Let's go to real quick. I'm going to go to Finviz. There we go, Finviz. And look at Finviz, and we'll just type in Microsoft. All right, so you type in Microsoft, and you look at insider sales. You can scroll down here. These are all the buy recommendations. There should be a... Oh, here you go. Insider sales. It used to be... Oh, it looks like it's changed. Bill Gates was selling... It was something like 100,000 shares a day. And it looks like that has now changed, but he was just unloading almost every single, and maybe it's because he's no longer an officer and he moved his shares into his corporation. But he had so many shares of Microsoft that you kind of have to sell. It's just way, 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 way too much. Brendan says insiders do not equal smart money. Very true. That quite often it can be dumb money. However, I think in these cases with somebody like Elon Musk or Bill Gates, who had almost all of his ducks in Microsoft shares, you have to diversify and get some of that money out. You didn't get alert for the start of the show? I don't know. I'm going to click that little bell icon. How much time we got here? All right, let me just go. All right, so this one's from Doug. He says, I typically trade 5-minute and 15-minute entries at a 1% of my account. Is it wise to trade another 1% on swing trades, daily time frame analysis trades that can last a week or more? And if I do that, it ties up 1% for the long time I could use on smaller time frames. How does one balance this? Well, to me, Doug, it'd be simple. You balance this by looking at what's making you more money. Where are you seeing greater profitability? In general, those who trade short-term time frames are going to make more trades, which means you're generally churning your account. Now, right now you have a situation where the fees are a lot cheaper, if not free, depending on what market you're trading. So that aspect of grinding an account or trading a lot kind of is diminished much more so than it was when I was short-term trading. If you're trading 5-minute and 15-minute entries, you are going to be making far more trades than somebody who's using the daily as their time frame. It's just the nature of the beast. But one thing that you have as an advantage, if you're trading, let's say 5-minute entries, your stop losses are very small, right? You're still going to risk that 1% of your account, fine, but your stop losses are very small. And how do you make money that way? You trade bigger share size. So you've got more shares traded, small stop loss. If you're somebody who's looking at swing trading, trades the last couple days to a couple weeks, you're going to be trading with wider stop loss, which means you will be trading fewer shares. But you're also looking to make much bigger gains. Now, since your stop loss is bigger, that means that your position size would be slightly smaller. So it's this kind of trade-off between time frames. A swing trader generally will trade with fewer shares, but bigger stop losses and hold it for longer. A short-term person is going to be trading much more shares with tighter stop losses. That's why you're trading bigger shares, because your profit potential is usually reduced when you're looking at 3-to-1, 4-to-1 reward-to-risk ratios. I'm just trying to do 2% a day on my active account. That's pretty damn impressive if you're pulling off 2% per day. 2.7% today. Constant progress is better than active accounts. Long term, I don't care about 75% drawdowns. Well, I got to say, I care about 75% drawdowns. I don't want to see that. In crypto, like I say, that's a different ball game to me. But in my equities, my futures accounts, I don't want to see a 75% drawdown. So how does one balance it, Doug? Analysis. Find what works best for you. Maybe you play a little bit on the long-term side and say, all right, how much is this costing me? Or what am I earning relative to what I might be earning on the short time frames? And balance those two out. And what you might find out surprisingly is that by doing swing trades, you might be making more money making fewer trades than you would if you were doing active intraday day trading. One of my big gripes against day trading is it becomes compulsive. It becomes addictive. You start trading more and more and more and more, and next thing you know, you're forcing trades to happen just because you feel silly sitting there not doing anything. That's tough. For me, I really like the transition that I've made, which is I'll look long term, and if I find opportunities, I'll take them. If I don't get an opportunity, I just throw up my arms and go, oh, well, I'm not in anything right now. I'll wait till tomorrow. I'll see what I can find for tomorrow. Exactly, but you know what, Doug? I love it. He says, thanks, plus that long-term bores the hell out of me. You know what? It should. Trading at its finest should be boring. And if it's boring and you're doing long-term trades where literally you can maybe look at it once a day and move your stop losses up, then what does that give you the freedom to do? Anything else. Spend time with family, go to the beach, go to Disneyland, go to football games, whatever you want, study something. It gives you a lot more flexibility as opposed to being a short-term day trader where you're like constantly glued to that screen, like a zombie, and your eyes hurt by the end of the day and you haven't accomplished much. So it was an interesting transition. I love day trading just because you're in, you're out, and you don't have to worry about anything else. But I definitely am a fan of swing longer term. All right, let me wrap this one up here because I got to get going. I have no guest tomorrow, so again, I got a couple questions I didn't get to. Les, I have a question for you as well. I want to make sure I get to on tomorrow's show, so I will do my best to get to all those. Of course, if you have anything to discuss, talk about, comment, I love that you guys put comments down below the YouTube video. That's fun. I'll just go back through and read all those and incorporate those questions into the show. So if you have some, go to YouTube, put your comments and questions in there, and I will get to all that on tomorrow's show. Or you can email me at TraderMerlin@gmail.com. Now, here's what's cooking for tomorrow. Obviously, given what happened with the CPI numbers today, all eyes are on PPI. Now, if there was such a huge decline in the consumer's price index, it would be logical to assume that the producer price index is going to decline as well. Now, does that get down to zero? Who knows? If it does, I think you're going to see another big surge in the equity markets tomorrow. You also have unemployment claims, natural gas storage, mortgage delinquencies, 30-year bond auction. It's a busy day. Plus, if you have, hey, MMT, welcome. Say hi to Don for me, and good to have you here. If you look at the GDP numbers, you can see for the British pound, they're expecting their economy to decline significantly. They had some growth the previous month of 0.5%. Now all of a sudden, they're expecting a negative 1.2% decline in GDP in their GDP number for the British pound. Now, why is that interesting? Because if you look at the British pound on a daily time frame here, it looks like it's actually kind of turning a corner. We've kind of bottomed out a little bit. The big moment will happen, in my mind, in the next couple days when we get a breakout of this last little range-bound move that's had. So there is, oops, get that out of there. There is your current range-bound market for the British pound. Boy, tomorrow, if they have a really, really positive GDP number, you could see this thing rip, right, and have some really nice activity. So anybody trading that British pound, I want to keep an eye on that. Now, we also have earnings coming out tomorrow. You can see here, nothing exciting. Illumina, Canadian Goose, who apparently makes jackets out of wolf pelts. That's nice. Himax Technologies, Cardinal Health. Most of these you probably aren't even trading, but I thought I would say there's I think it's like 230 companies reporting earnings tomorrow, but not really anything that exciting. Mark, no, Jerry Baldwin was on yesterday. That was yesterday's show. Today, it's just me, lowly old Merlin, trying to fix this audio and get my air conditioning working up here. So again, I'll remind you guys, I won't be doing a show on Friday, so I can cool this place down and not look like a sweaty red tomato on the show. And I will try to get this camera working out here. Anyway, that will do it for me, everybody. Hope you guys have a fantastic one. Be careful out there with that PPI number. It's going to be a wild ride tomorrow. I'm hoping I get some nice upside potential into some overhead supply and maybe one last short attempt on these markets before I throw in the towel and just become a perma bull like Brendan. All right, everybody, that's going to do it. Hope you all enjoyed it. Have a great session. Leave me comments down below YouTube videos. I will see you all tomorrow. Take care.